Good morning, everyone. Thank you very much for dialing in and joining me on the webinar. This is the DAX Open with myself, Russell Shrom, Senior Market Specialist at FXCM. My email address, r@fxcm.com. Today is Wednesday, it's the 29th of December 2021. I'm just going to bring up our high risk investment warning. Just want to keep this on screen for a few moments. Hey KD, hey Howard, no worries, pleasure corresponding. And I just want to, I've got an idea. It's a slow week. We'll do some DAX analysis, but I want to just talk also in terms of something. What am I trying to say? The portfolio approach to investing. Just want to mention the portfolio approach to investing. I think it's quite pertinent and definitely food for thought. Let me just bring up our market commentaries disclaimer. And here is the references, market scope. We'll start off with CNBC, just the morning note, which starts off as European stocks are set to fall in holiday thin trade. And all right, European stocks look set to fall at the open as holiday thin trade continues, and global investors are looking for a Santa Claus rally to close out a year in which the S&P 500 has rallied more than 27%. I'm not quite sure what this advert is here, so I'm begging your pardon. The benchmark index historically gains during the Santa Claus rally, so it looks like we're in the midst of this rally, which we have spoken about, but don't bank on it. The final 5 trading days of the current year and the first 2 of the new year. So let's just US stock futures did move up on Wednesday, and quite a mixed session on Tuesday. Market players have spent recent weeks juggling concerns over new COVID restrictions and tighter central bank policy. New study, early study suggesting Omicron is milder than previous. New studies in South Africa and the UK last week suggested a reduced risk of hospitalization and severe illness. At the start of the week, infections were topping 100,000 in the UK, and France also having half figures. All right, so let's just bring up the DAX. So we have had a strong week. This is a weekly chart. You can see the candlestick here is a blue candle. We've got 1, 2, 3, and then 1, 2. Okay, so it looks like we're in the middle of an impulse. Again, we'll see how this candle closes for the week. But right now, it's an active candle that's looking quite bullish. The RSI over here is above 50, so that's positive. But the real key for the DAX is for the stochastic to get into that 80 level. Now, the 80 level is generally where the momentum takes prices higher. Generally, you can see over here we kind of moved flattish, but the any sort of move, sustained move, generally takes place in that upper quintile. So the fact that we've got this turnover here, I think, is something we need to keep an eye on, and we wanted to hit that 80 level and hold. Just go down to the daily chart here, and I like what I see. It's in zone 1. That's our area of strength. As long as we stay in zone 1, then we've got a good probability of upwards movement of prices. If it goes into the neutral or lower zones, well, of course, that's going to hurt the chances of. So the fact that we're there is good news, and also the stochastics are moving in that northeasterly direction. So it's very, it's a very good looking chart. It's a daily chart, so the candlesticks are reflective. So here's Monday, Tuesday, Wednesday, they're all very strong blue candles, are reflective of a strong weak but on thin trade. So of course with that we need to just be a little suspicious. You know, I don't know what would happen to the price candlesticks if we had normal liquidity. You know, I'm just saying that it's not not a reflection of a normal day in the stock market. Nevertheless, it's moving in the right direction, and that's good to see. If we go down to our hourly chart here, for upwards movements, we want the moving averages to show that angle and separation. We want to see that angle and separation. And again, the stochastic moving into the upper quintile would be regarded as bullish. So, you know, the fact that the CNBC article says markets are going to sell off pre-market on the open, well, okay, let's see what the charts tell us. Okay, so if we get the angle and separation on the exponential moving averages in the north easterly direction, well, that's bullish. If the CNBC article is correct and it crosses down, well, then we have confirmation from, when I say if it crosses down, if the EMA is crossed down, then we have confirmation of that. So I don't think that CNBC article gave us too much to work with, but understandably it's a slow week, right? So we'll just keep an eye on the market for the first hour, and then we'll get an idea in terms of the exponential moving averages and the stochastic if it gets up to the 80. If there's any questions there, type those out, because I want to just go into something a little bit more theoretical, but in my opinion, very, very important for investors generally, which is the portfolio approach to the markets. So let me just bring up my Microsoft Paint. All right, so this is going to be a little bit theoretical. I'm not going to spend too much time on it, but you can get kind of really deep into this stuff. So I hope I do enough justice to make it worthwhile to the regarding the content. But just to start off with, let's put 3 lines in. All right, so this is a spectrum, and the spectrum oscillates between 1 and -1. I think some of you would have seen this before. And right here in the middle is 0. So what am I showing you guys here? This is what's called the correlation coefficient. Okay, and there's a statistical formula behind it. But the idea is you can be anywhere between 1 and -1 on the spectrum. If you are at 1, it means you've got a perfect correlation between 2 instruments. So instrument A would move up, and at a correlation of 1, instrument B would mirror that perfectly. Okay. So that's why what one. So the question I'm going to ask you, okay, now is does that provide any sort of diversification benefit? Anybody got any comment on that? Just type it in. If you trade two instruments and they've got a perfect positive correlation, do you have any diversification benefits? Anybody want to have a go at that? Nobody's typing. We're definitely between Christmas and New Year. It says no, and he's right. There's no diversification benefit here. Let's just say you've got $50 in instrument A. Let's say you've got $50 in instrument B. Well, you can just put $100 in either one of those, and you're going to have exactly the same exposure. There's no diversification benefits. What about this one? Let's say, let me get this. What about if you are at -1? This is called a perfect inverse correlation. And what that means is whilst instrument A moves up, instrument B would be moving in exactly the same sort of amplitude and magnitude, but in the opposite direction. Okay, so now you've got two instruments. They're moving completely in sync, but each one is moving in a completely different direction. And again, the question is, do you have any diversification benefits from that? What do you guys think? Katie says no. Howard says no. Well, you have effectively created what you've done here what you've effectively done here by assuming a portfolio at -1 is you've created what we call a riskless portfolio. You can't really lose cash because everything that you gain on the one side, you're going to lose on the other side, and everything you lose on the one side, you're going to gain on the other side. You've basically got a riskless portfolio, which basically is as market participants, we want to avoid a riskless portfolio at all costs. We do not want a riskless portfolio because a riskless portfolio means zero profit. So you can't lose any money, but you're not going to make any. So without risk, you've got no chance of making a profit. There's risk. There's a relationship between risk and reward, right? So there's going to be some sort of balance. There's got to be some sort of balance between -1 and 1, because if you're at -1, well, you've got a riskless portfolio, and at +1, you've got an extremely risky portfolio because you've got no diversification benefit. If you are at +1 and the market goes up, okay, well, that's very good. But if the market goes down, all your positions are going to lose. Okay, so you've got a high risk at +1, and you've got a completely no risk at -1. Okay, well, that's kind of the point. We want to be somewhere in between, don't we? And that brings us to zero. Brings us to zero. Okay. Now zero is quite a sort of an abstract number to get your head around, but it means there's no diversification between the instruments. In other words, let's just say instrument A moves up, and we can ask, well, what is instrument B going to do? And we don't know. Okay, we've got to look at it. Instrument B will do what instrument B is going to do because there's no correlation at all. Okay, so we've got two instruments and they are completely uncorrelated. Now, the question I'm going to ask is, do you get a diversification benefit from that? Do you get a... What do you guys think? Howard's asking, how do we get a... Yeah, Howard says yes. He's also asking, how do we get the coefficient correlation? I'll show you the formula, okay? And I'm going to ask you guys to excuse me because it's very statistical. We're not going to get into it now. We may do an ad hoc on it next year, Howard, but I'll show you what the formula is. Just to answer the question. Don't worry too much about it just yet. The point I'm going to make is going to become apparent in a moment. But so we've got instrument A and we've got instrument B. All right. So the correlation is complex because it's actually made up of a multitude of statistical formulas. So the first part is what we call the covariance. Okay. Don't get too don't worry too much about it right now. So we've got covariance of A and B, which is effectively okay, the same thing as correlation, except it's unbounded. So there's no one, there's no minus one. In fact, because it's unbounded, it goes up to positive infinity and negative infinity, and that makes measurement impossible. Okay, it makes measurement completely worthless. That's why we move covariance, which again has its own formula. So what we do then to make a covariance of correlation, we do this. We do standard deviation of A times the standard deviation of B. All right, we multiply those together, and then we divide covariance by the product of these two standard deviations, and that equals correlation. So you can see there's a fair amount of work. So you've got covariance, that's a calculation in of itself. Then you've got standard deviation, which is a calculation in of itself. And then you've got to work these all out, and then you come up with a correlation. So we won't get into it too. The point is that what we're trying to do is we're trying to make a point. And the point is we're trying to promote the benefits of diversification. Okay. So, and the reason we're trying to promote the benefits of diversification, because if you are at +1, you have assumed huge amount of risk, okay, which means high reward, but it means high risk. And at -1, you've assumed no risk, that means no reward. So you kind of want to try and find a sweet spot there, which is around 0. Now, again, I'm trying to sort of do justice to this without making it seem too boring. So just let me know if I'm succeeding or not succeeding. But I'm going to make a point now. Yeah, I'm going to use, I promise you there's a point. All right, so then I'm going to just put on some axes. And on these axes, I'm going to put in standard deviation here, which is effectively risk. We're just going to call it risk, okay? Any brackets measured by standard deviation, okay? Which again is a statistical. Just think about it as risk, okay? And then on the y-axis, we'll just put return. And this is the point, is that when you combine these two variables, there is a relationship. And we know that there's a relationship because we've just seen it in terms of correlation. There's either a correlation that's going to increase your return and increase your risk, or it's going to lower your risk and decrease your return, right? +1, -1 on the correlation spectrum. Now, we saw that there was instrument A, and here's instrument B. Okay, here's instrument B, and let me just label them. And if we say that these guys are positively correlated at 1, okay, if we say they're positively correlated, that means that if A moves up, we know B is going to move up by exactly the same magnitude, amplitude, frequency, etc. Well, if that's the case, you're going to get a linear function. You'll get a linear relationship. In other words, A's risk, B's risk, and you're just going to expose yourself to more risk. Okay, if you combine these two into a portfolio because they positively correlated. I just want to stop there. Does that make sense? If these guys have a positive correlation, okay, you've got 50, you've got $100, you put 50 in A, you put 50 in B, okay, your risk is going to increase than if you were just holding A, or if your risk is going to increase if you were just holding B, because now you are not exposed to $50 loss, you're exposed to $100 loss. But of course, because you've got the extra $50 in the market, the chances of you making more money is there. So higher the risk, higher the reward, right? So that's point. So that's the first point. The second point is, well, okay, let's say that these guys are at -1. Let's say these guys are at -1. In other words, okay, you're going to have zero. You're going to have zero risk, because we saw it -1. As the one goes up, okay, as the one goes up, then the as the one goes up, the other one's going to go down. So your return is going to just be 50 plus 50 divided by 2, $50, and it's going to just be at this sort of area here. So you'll be here with zero risk, and you won't move off of that, okay? Because it's impossible to grow your money if one is moving up, okay, and if one is moving down, and they're moving exactly the same sort of frequency amplitudes, but in opposite directions. Does that make sense? I feel like I might be misexplaining this. If they've got a perfect correlation, you're going to have a linear function where you're going to be just kind of moving like this, right? You'll just be going. Eventually, you'll have like way too much risk. But if they're completely inverse, well, you're going to be at a riskless portfolio, and you're going to be having, you'll make zero cash. Okay, now the question is, well, all right. So these are two extremes. We're either here, and then we'll never move off of this point, okay? Or we're going to just have a huge amount of risk. Well, what happens if we are at 0? What happens if we are at 0? Well, this is where it becomes interesting. Okay, so at 0, you get a curve like this. If I can do it. All right, let's just do that. I'm going to change it to red. Make it a curve like this. Believe it or not, that's what you're going to get. So now, if you had to work out statistics, if you combined A and B in the correct weight, whatever that weight is, eventually you're going to hit a sweet spot. Now look what the sweet spot does. Okay, this is kind of, so A A, lower return, but lower risk. You guys see that? So A has lower risk than B. A has just on an individual basis, A has a lower risk than B, but it also is going to give you less return because you've assumed so A's got a lower return. Okay, B has a higher return than A, but high risk. Okay. Now, if you're going to combine A and B, it's either going to be there's three ways that you can combine it. Either on a linear scale. Let's make this. Either on a linear scale. Let's make these three different colors, which is going to increase your return, but it's going to increase your risk. Okay. Or it's going to be on a negative. It would be, so this is linear positive, or it's going to be linear negative, which is going to give you much lower returns, much lower risk. This intercept here is wrong, by the way. But anyway, the point is it's just going to be constant at zero. This is your sweet spot. You've kind of combined where you've got a higher return. Okay, you've got a higher return than just being at A. And you've got lower risk. So you've got higher return. But at the same time, so what am I trying to say here? I'm trying to say, yeah, if you are, okay, this is the point. I'm not sure if I've done this justice. I might have to revisit this. If we at point A, okay, if we are at point A, and we want to increase our returns, best scenario would be to lower risk as well. Okay, so to get from A to, let's call this C, you've actually achieved that. You've actually achieved that. In other words, okay, you have got a higher return at lower risk. And that's what diversification does, correct diversification. All right, is that there's a sweet spot. Now, what's the whole point? Okay, well, think about A as, again, this is, just treat this as pure sort of an educational type of thing. Treat A as money in the bank. Okay, treat A as money in the bank. Okay. A as money in the bank. So we here, which is not really an apt. It's not really apt to call A money in the bank. Money in the bank would be here. It doesn't matter. And let's just say you want to increase your returns, but you don't want to risk. You don't want to risk all that money. What if you move some of it? If you move some of it, okay, into B. If you move some of it into B, well, look at the benefits of diversification. Your returns increase and your risk decreases to a point. Because once you start putting too much money in B, well, then you're starting to expose yourself to risk. So if you want to get from A to if you want to increase your returns to A, but also increase the efficiency of your portfolio, well, going into some sort of risky investment on a theoretical basis is something that somebody can consider, okay? but it's to a point, because once you go past point C, your risk starts increasing again to a point where you actually are exposed to more risk. Okay, you're actually exposed to more risk. Can you hear me? Katie, can you hear? Can you guys hear me? Okay, cool. Howard, can you hear me? Katie, can you hear me? So the idea here is, okay, is that you want to achieve. So let's get rid of all of this. I'm not sure I've explained it 100% correct, but I think that the point has been made. And I think we'll do a full-on ad hoc webinar on it next year. But the point is, okay, the point is, you can bring your risk down. You can actively bring your risks down through diversification. Okay. Eventually, there's such a thing as being over diversified, right? You kind of this would be sort of pretty flat. So there's a sweet spot in terms of diversification. So what's the big takeaway from this? The big takeaway from this is that, well, you know, FXCM, being a broker, attaches with its stable of instrument that it offers, provides you opportunity. Okay, there's opportunity for return. Okay, but there has to be accompanied risk. Okay, there has to be accompanied risk, because we've seen without risk there's no ways to make a return. So you've got to embrace the fact that, gee, my spelling is awful. You've got to embrace the fact that there is risk that gives you the opportunity to make return. However, as market participants, what you would ultimately want to do is you want to increase your returns. You want to increase your returns by lowering your risk. You want to increase your returns by lowering your risk. Okay, so this kind of got to be kind of like a movement like that. And the idea here is, well, don't put all your eggs in one basket, because you've got to try and pick a sweet spot between +1 and -1. So you've got to try and get here. So trading, okay, should be one part of a diversified portfolio. It should, okay, bring down your risk if you're well diversified. It's not. It doesn't mean that trading is not risky. Trading is very risky. But with that risk, you're adding the benefits of return to a diversified portfolio. And that means when there's other parts of your portfolio which are not performing, well, then your trading potentially is keeping you on track. And when your trading is not performing, then the other parts of your portfolio are keeping you on track. That's the whole point of diversification. So there is a place for trading, okay? But in my opinion, in a diversified type of portfolio, there's I think everybody knows the, you call it an idiom, don't keep all your eggs in one basket. And that's really the point I wanted to make. I think I may have made a few mistakes in the theoretical representations, definitely in terms of saying A is a risk-free asset, because that's clearly not correct. In fact, just to make a final point, the actual portfolio would look something like this. So again, we've got return here, got return here, and we've got riskier. This is what we've seen before. And when I introduced money in the bank, I actually should have put it over here, because money in the bank generally, I mean, assuming that it's a decent bank, I mean, we've seen banks go under, but you should have naught risk in a savings account and earn a very low return. Okay, and then we've seen that there is a sort of a kind of a frontier. It's actually called the minimum variance frontier. Believe it or not, not like that. It's got to be like this. It's called the minimum variance frontier, and there's some cool stuff about it, but we won't. But we've seen that the sort of sweet spot. Okay, we've seen that the sweet spot is like round about there, because that is where you're getting your lowest risk in terms of portfolios that have risk attached to them. So we've got risk-free over here, and we've got so if you're 100% in risk-free over here, and if you're 100% in risky over here, well, portfolio theory says you can kind of do even better. Okay, and that's through diversification. In fact, the optimal market portfolio would be here. All right, where there is a tangent to this frontier based on what's called capital. This is called capital allocation. So when you start allocating your capital allocation, okay, how much percent do I put in the risk-free? How much percent do I put into the full risk? Is this going to be 10%, 90%? Is it going to be 20%, or is it going to be 80%? And you kind of start playing around with the mathematics and the calculations. Well, the mathematics would actually put you at an optimal portfolio somewhere over here. Okay, the optimal market portfolio. It doesn't mean that it's the optimal portfolio for the investor, because each investor has his own different risk profile. So a very risk averse guy might only find himself here, which is better than having 100% cash. Somebody that's a huge risk seeker may be borrowing money, okay, and so you borrow money on margin and you kind of would be here, and that's sort of FXCM, right? But sort of there's a spectrum to play kind of in between. So that's just kind of the theory of portfolio theory. I hope I didn't fluff it up too much, but I just wanted to sort of share that with you guys. Does that was that okay? Did I lose you guys, or are you okay with that? All right, I think we'll just wrap it up there. The takeaway, okay, the key takeaway here, if I had to sum everything up into a sentence, don't put all your eggs in one basket. Thank you very much, guys, and chat to you again tomorrow. Thanks very much.